Yeah, good morning, guys. Welcome to IPE501 class. We're going to be discussing the major topic which we treated in the course of the lecture, which includes the capital budgeting, cost analysis, and the make or buy decision. So I'm going to be starting with capital budgeting, and I can dive into the rest of this. So for capital budgeting, it involves capital. You're budgeting what your capital. That is when you want to go into any business, like yeah, you're investing. The money you're investing is more like a capital, and you're going to calculate that this capital I'm investing this, will I get this back within certain period of time? Probably you need your money back at the end of that. So capital budgeting, there are different techniques in which you can calculate. There's a traditional and there's a discounted flow method. For the traditional is divided into the payback period method and the accounting rate of return. And for the discounted cash flow, which is DCF is divided into the internal rate of return and the net present value. So next, we're going to be moving to the payback method. Although in capital budgeting, there are things which guys need to know. There are steps involved in capital budgeting, which involves the identification, the evaluation phase, the authorization, and monitoring. For the identification, you identify major projects that is, can I invest in this? Probably you need a machinery in your organization. Should I go for this that's semi-automated or fully automated? Depending which is going to give you higher return at the end, you can invest in that. So for the payback period method, the difference between the traditional and the DCF is that the DCF takes note of the time value of money and it involves all the cash involved during the process, whereby this does not take note of the time value of money. Although you guys might be wondering what the time value of money is and the cash flow as I'm making mention of, like as we proceed in the course of this lecture, we are going to figure out what that is. So for the traditional, we're moving into the payback period method, the PB. So for the payback period, this is talking about how soon you can get your cash back. And how soon? So if I should invest 20,000 naira in a business today, how long is it going to take me before I get 20,000 naira back? That's what the PB is all about. And there are three different methods in which the payback we can calculate the payback. The first one is payback with constant cash flow. Constant cash flow. That is what, let me pause this. Before I proceed, what's our cash flow? The cash flow consists of both our cash inflow and the cash outflow. For the cash inflow, it's money coming in, cash outflow, money you are giving out. And most times, of course, I have to say that again. Let me confirm that statement. Let me confirm that statement before they will come for me. For the first part is in the payback period, payback with constant and equal cash inflow. That is what I mean by the cash inflow. It's money coming in into the organization. That is money you're receiving. While your cash outflow is the money you invest. That is your capital. Why cash flow is collection of both the inflow and the outflow. So for the first technique in the payback period, when you have payback with constant cash flow, the formula to calculate the payback period is what your initial investment over the what cash flow. Let's say for example, you are investing 100,000 naira into a business and it is required that you are going to be getting what 20,000 naira every month or every year. Let's use year for example now. What is going to be the payback of this? Your cash flow here is what? Your 20,000 naira, which you can also call what? Your cash inflow. That is the payback period for this is going to be what? 100 divided by this, which is going to be what? 5 years. So this is easy. Your payback initial investment over the cash flow, the initial investment divided by the cash flow, it's going to give what your payback period. The next step we're going to move into going to be what the payback period with what unequal cash inflow. So the second technique is the payback period with the unequal cash inflow. So the other one we talked about, the cash flow was what constant. So you keep getting what 20,000 naira every year. So for the unequal cash flow now, this is a table showing the cash inflow. That is the for the first thing when you started the business. This bracket here is indicating that it is what negative. And negative means that money you are putting in or the money you are yet to what get back from the business. So this, you invested what, 200,000 naira into a business. At the end of the first year, you have to get what, 80,000 naira in return. Second year, you have to get 70,000 naira. So you can see how the inflow you are getting after every year, it's not what's equal, it is varies. So for the first year now, this year zero, this CCF means what, your cumulative cash flow. So the cumulative cash flow is like the sum of what, your cash flow. For the first year, for this year zero, it's always still going to be what, the amount that you would invest into the into the project, which is what, 200,000. So at the end of the first year, you gain what, 80,000 naira. It means that what, you are still on a deficit of what, 120,000 naira. So you can what, put this way, the bracket indicating that you are still on a deficit. At the end of the second year, you gain what, 70,000 naira. So the 120 minus 7,000, that's 50,000, of which you are still what, in a deficit of what, 50,000 naira. After the third year, you invested what, 40,000 naira. You gain 40,000 naira again, which means you're still in the deficit of 10,000 naira. That is the cumulative of the inflows. While at the fourth year, they've made your capital back, but then you're having an additional gain of what, 40,000 naira now. So how do you get your payback period here? The payback period is going to be what, in the fourth year. But you should actually consider that this 10,000 naira that you are left to get, you would have what, gotten that before the completion of the fourth year. So how do you get what, the value of, let's say for example, this are in years. After the third year, you haven't made 10,000 naira back, but at the end of the fourth year, you're already on the profit side. So it can, let's assume, let's say January, you made 10,000 naira in January, 10,000 naira like that for a month. So at what particular month, it's not at the end of the fourth year, it's going to be what, 3 years plus X months. The payback period for this is going to be what, 3 years plus X month. So how do you get the X month? The X month is going to be what, this that you're having here, your 10,000 naira over what, this, which is the same 0.2. So the payback period for this is going to be what, 3.2 years. For the payback period with unequal cash flow, these are the number of years. This year zero indicates the year where you started the project, that is how much you are investing into the project. So this bracket is showing that it's on the deficit, that is a negative sign. And this is year one, that is year one, you made a profit of 80,000. Year two, you made a profit of 70. Year three, you made a profit of 40. Year four, you made a profit of 50. So after the first year now, this your investment year, you are still on the deficit of 200,000 because you've not made any money. For the year one, you made 80,000 naira. What you invested was 200,000. So how much is left for you to gain? 120,000. So you can just what, your 200 minus what, the 80,000, which is 120. So you see now you are still on the what, a deficit side. For the second year, you made 70,000 naira, of which it remains for you to recover what, 120,000. So that's going to be like 120 minus 70, which is what, the 50,000, of which is still like a deficit. For the year three, you made 40,000. If you should settle 40,000 out of this, you're still going to be in a deficit of what, 10,000 naira. So after the third year, you've not made your capital back. But after the fourth year, you made 50,000. 50,000, when you settle your debt, you are already on the plus of what, 40,000 naira. So this is at the end of the fourth year. Although you will have gotten your money back before the end of the fourth year. So how do you get the duration which it takes for you to get the money back before the end of the fourth year? So all you just have to do is to take what deficit which you're having here, the 10,000 naira divided by the 50,000. So this is adding like a decimal point, that is 3 years plus something more. So the month here it's going to be what, 10,000 divided by 50 here, which is what, 0.2. So it's going to take what, 3.2 years for you to what, recover your capital back. So for payback period with unequal cash flow, it takes what, does not necessarily means you're going to take the exact period of years that you're having here. So the only time you're going to take the exact period of years you're having here is when you get to your cash flow, you're having a zero balance at the cash flow. That means it took the end of that year to what, clear your debt out. That's on that. So the next technique in which your payback period can be calculated is whereby you have the payback period with a bailout factor. So what I mean by the bailout factor, like we have in this question now, the scrap value that we're having here is the bailout factor. For example, now you get the machine, you invested in the machine for 400,000. So you know, at the year of investment, you can't decide to sell the machine when you just invest in it. So let's say, for example, after the first year now, you've made 200,000. Although you don't want to continue with the project again, you can decide to sell the machine out for like 150,000. But one thing you need to consider is that as the year increase, the value of your machine is what decreasing. Let's say, for example, you buy a car this year, 200, you buy a car this year at 400,000. At the end of the first year, after using the car for a year, you won't be selling the car for 400,000 again. You'll be selling it at what? 150,000. After the first year to the second year, you can't sell that car again for 150,000. The value has to drop to like 110,000. And the third year, the value is dropping to 70, 40, like that. As the year increases, the value is dropping until it gets to zero. So we are considering that here. That what if I don't want to continue with the project? What if I want to sell this project out? That's what the bailout factor that we are having in this. I mean, so the same way we calculated our cumulative cash flow the other time when we did with unequal cash flow, that's the same way we are calculating our cumulative cash flow here. So for this, year one, you've not made anything, you are still in a loss of what? 400,000. So after the first year, you gain what? 200,000. You're going to be in a deficit of what? 200,000 this way. So you made another profit of 8,000 after the second year. You've not gotten your capital back. You're still going to be in a deficit of what? 120,000. After the third year, you made 40,000. You're still going to be in a deficit of 80,000. This you're in a deficit of 30,000, and this for making a profit of 10,000 naira here. So most times it's always advisable you calculate your cash flow when you are with a bailout factor before you consider the scrap value, just to be on the safer side. So now moving to the considering the bailout factor that we are having here. After this year, this is still going to be, because I can't decide to sell my project when I just started the project. So for this, I'm still going to be on a deficit part here. So what if I don't want to proceed with the project after the first year? Though after the first year, I've made 200,000, but I want to sell this out at 150. If I just sum those monies together, it's going to be what? 350,000, of which is not what? Meeting the actual demand here. So by the time I do this, if I should sum this, I'm going to be in a deficit of what? 50,000. So it's not advisable I quit on the business after, because I've not made my money back. So it's not advisable I quit on this business because I've not made my money back. Let's consider after the second year. That is, I made 80,000, but then I can't sell this business at this again. So this is going to be the reason why I brought this table out, is just to show that this part, what I'm having here, is what my cumulative plus the scrap. That is the analysis behind that. The cumulative plus the scrap. If I do the cumulative for the scrap here, I'm still going to be in a deficit of what? 10,000 naira here. So let's analyze this now. That is, after the second year, I made 80,000. 80,000 plus the 200,000 I made in the first year, that's like 280,000. Then after the second year, I can only sell the business for what? One for 110,000. The 280,000 plus 110,000 is going to give me 390,000, which is going to mean that I'm still going to be owing what? 10,000 naira at the end of the business. If I just sum this together, also I'm still going to be in a deficit of what? 10,000 naira. If you analyze that also, that is by summing all this together, as the money I've made in 3 years, it's going to give me what? I'm still going to be running at the less of this. As in, when I sum this, it's going to give me 320,000. This plus this, 320,000. Then if I take 320,000 away from this, I'm going to be running at a loss of 80,000. Then if I sell it out at 7,000, I'm still going to be at a loss here. So it's not advisable I back out after the third year, because I'm still on losses. After the fourth year, I'm on a loss, but I can sell for this. So when I use to sum this together, this is going to give me what? 10,000 naira. So we can say that what the payback period for this project is what 4 years. That is, after the 4 year, I can decide to what sell out the project and I'm no longer interested in this. I'm going to make my capital back. So unlike the payback period we discussed last time, the one with unequal cash flow, we can have our payback period before the end of a particular year. That is where we had the case of 3.2 the last time. But for this, you can only what sell out the project at the end of a particular year. So there might not be case for what decimal. That's if your cash flow is still on a negative. But by the time you do the sum of this, when you are considering your scrap value is always taken to be what at the end of the year. So it's at the end of the year you are using what this price. So for this, you can't have a decimal in your answer. But for the previous, this probability of you having a decimal, that's if you don't meet what the total balance before the end of the month. So that's all on payback period. And what are the limitations of this payback period? It does not consider the time value of money, and it does not take consideration of the total cash flow. It does not, probably in the 6th year of this project, probably you are going to make an additional gain of 100,000. It's not concerned in your payback period. Once you've gotten your capital back, it's the end of the whole project duration. So that's all on payback period. Next, we are going to move into the next present value. So like I said the previous time, one of the limitations of the traditional, which was the payback that we talked about, was it does not consider the total cash inflow. Total total cash flow. That is, once you get your payback money, you can what quit the whole process, and it does not consider the what time value of money. That's what I mean by the time value. Let's say, for example, you are expecting that you are going to get 20,000 naira in the next 2 years. The 20,000 naira you are going to get there is different from 20,000 naira of now. Let's say, for example, you're having 20,000 naira in January. The 20 naira that you had in January, it's different from 20,000 naira that you're having now. Based on, let's take petrol for example. With 20,000 naira now, you can buy just maybe 24 liters of oil. But in January, 20,000 naira, I know how many liters of oil you're going to be able to buy. You'll be able to buy, like, if not 60 plus. So the payback does not consider the time value of money, while discounted cash flow considered. And this makes use of principle of what discounting. That is, start from what the future value. That is the money we want to get in the future. We're going to convert that money to what present value. That okay, the 100,000 naira I want to get in 2 years. What is the value of 100,000 naira now? So we're going to what make use of that value. And discounting, we should also understand the concept of discounting, that it was compound interest in what reverse. Alright, so explaining the concept of the compound interest, let's take this illustration for example. Suppose a company has 10,000 naira and wants a return of 10% just each year. At least, okay, we want to determine what's going to be the value of this 10,000 naira, that is after the 3rd year. So for the first year now, the 10% of this 10,000 naira is going to give us 1,000. His investment, the value of his investment is going to be 11,000 afterwards the first year. After the 2nd year, the 10% is now going to be calculated on what? This 11,000, not the initial 10,000, which is going to be of an interest of 1,001, which is going to be 12,1. And after the 3rd year, 10% of the 12,1 is going to give us what? 13,300. So this is just like the concept of what? Compound interest. At least it is adding your interest at each year according. But if it was for simple interest, it's going to calculate it directly. But so this now, the future value of this 10,000 naira after 3 years with this rate is going to be 13,300. So that's what this relationship that we're having here. That is, our future value is also equal to what? The present value into bracket 1 plus what? The discount rate that we're using, or the interest rate, and it's what raised by what? The number of years. So if I want to calculate what's going to be the value of this 10,000 naira at this rate in the next 20 years, it's just easy for me to what? Use this formula instead of going through this process of doing this what? Line by line. So if I have a future value, same way we have, if I'm to get a return of 100,000 naira in future, what's the value of that 100,000 naira now? I can just bring this as what? As my present value is going to be what? Future value over what? 1 plus what? R raised to power what? N. And if to get 100,000 in 2 years, I can use this formula to what get the value of that 100,000 naira now. Whether I'm giving what my discount what rates. So this that I'm having here is also same as what FV times what 1 over what 1 plus what R raised to power n, whereby this that I'm having here is called what my discounting what rate. So the net present value, which is what the technique under the word discounted cash flow. For this, it takes what accumulation of what all the sums of what present value of what all the cash inflow. So like this illustration, you should be familiar with this kind of table. That is the year. These are 4 years. You invested what 100,000, and at the end of each year, these were the returns you are getting. So what you just have to do is that all this cash flow, the money you are getting, you what calculate what the present value of this money. So are given below. And for this question now, the investment rate, the capital investment rate was given as what 15%. For this particular question, the capital investment rate was given as what 15%. So all we just need to do is what discount what all these rate that we're having back to what get what present value. That is, after year one, I'm to get 60,000. What's the present value of 60,000 I'm going to be getting in the current year one? All I just have to do is to use what this discounted factor. From the previous time, I talked about what uh present value, which is equal to what your future value over what 1 plus R raised to power what n, where this is your discounted factor. So I can just bring this out as my discounted factor, have it this way, and what multiply it with what the future value, that is the value that I was coming in after what a particular year. So for this, how did I get this? If the first year is 0, any raised to power 0 here is what 1. So 1 over 1 is going to give me 1. That's my discounted factor. This is more like 1 over, but always know that was for your year 0, your discounted factor is going to be what 1, because number of years what 0. When you start, your discounted factor for this is always going to be 1. And for year 1, and how did I get this? This is what 1 over 1 plus what 0.15. All this raised to power what 1, using what this formula. So this is going to give me what this. For this is what 1 over 1 plus 0.15 raised to power what 2, and so on like that. This is going to be this raised to power 3, and this raised to power 4. That's my discounted factor. So what's the present value? The present value is going to be what the future value times, this is already 1 over here, so it's more like this times what your future value. So all that I'm having here, if I should multiply this times this, I'm going to get better. For this, I'm still on the deficit, which is what 100,000. For this now, this times this, I'm going to have, what's my calculator, 52,200. For this, it's going to be 60,000, 480, 26,000, 320, and this 17,160. At least this 60,000, the present value of 60,000 naira now is what 52,000 naira. The present value of 80,000 naira I'm getting after the year 2 is what this value. Present value of 40,000 naira I'm getting in year 3, this is what the present value of that, and this present value of this is what this. So all I have to do is what sum all my present value. This in bracket is what negative. So I can just what add all this together minus this. So by the time I do the sum of this, I'm going to have what positive 56,160. So you see, this is positive. So for this, when do you what accept the investment, and when do you reject the investment? So when your NPV is positive, you do what? You accept. And when NPV is what? Negative, you what? Reject. It means that this your NPV. If it is negative, it means that you won't get your capital back. It's after all this stage, you won't get your capital back. But for this, even though you've deducted the money, what you are supposed to get, you deducted it to the list that okay, this 60,000 naira that I'm getting, what is worth? Is worth 52,000. After deducting everything, you say you're still making what a gain. So it's more like you are even on the safer side, because what you are expecting, you deducted it, and at the end you are still making a gain. So you can say that for this, you accept what this project because your NPV is what value. So the principle of this NPV is taking sum of what all the present value. It's taking sum of that, and if the sum of the present value is positive, you what accept such investment. But if it is negative, you do what you reject. That's all on the concept of net present value. Okay, so next we're going to be talking about is the accounting rate of return. And the reason we're talking about this is because we need our ARR when calculating the IRR. Because the next method was in the DCF was supposed to be our IRR, the internal rate of return. So we need this. Let me just explain briefly the concept of the ARR. So to get your ARR is what? The average profit over the average investment times 100%. And how do you get your average profit? Your average profit is your what? Your cash inflow minus the depreciation. Cash inflow, that is the sum you're getting in. So in layman terms, I'll just say it's profit is what your depreciation can be like your cost price and this your selling price. I think you are familiar with that concept. Profit as well, selling price minus cost price. So for your depreciation is like I put here depreciation is what your initial investment. That is the amount you was putting into the business is what your depreciation. Why your cash inflow, that is what you are getting as a return. That is number of years. Probably you get 20,000 first year, 40,000 second year. So you sum that all together. As the money that comes in is what your inflow. So when you sum all that comes in minus all that you invest is what your profit. So to get your average profit is what profit divided by the what number of years. After getting the profit, you can do your average profit. That's for this. And for the average investment, your average investment is given as what your initial investment plus scrap value, provided is what is scrap value in the question. So if there's no scrap value in the question, the scrap value is going to be 0 divided by 2 plus what additional what working capital. That is probably you what put in money along the process. Probably you invested 200,000. After 40 years, you added what 20,000. You can what include that. But if that is not what included in your question, you can what make this be 0. And also take notes, in a situation whereby your scrap value is not included in the question, your average investment is also going to be what your initial investment plus 0 over what 2. So you don't say because you've neglected this you should ignore the parts and use, so it's going to be what this plus 0 over what 2. So that's for your average investment. So when you get this and this divide, you can get what your accounting rate of return. So let's take an example on this. Alright, so let's consider this example on the accounting rate of return. How to calculate our IRR. Take note of the formulas I gave initially. So looking at this table here, it is showing what the cash flow whereby you invested what 80,000 naira and it's showing the amount you're getting in. So let's say for example, if this particular investor, if he requires what a return of what, let's say 20%, like on this investment, like should he invest into this or not? So the same way we add for our net present value, then that if it is positive you can what accept the project, and if it is negative you can reject. Also we also have that for our ARR. For our ARR, if your rate is what below, if it's below what expectation, if it's less than your expectation you what reject, and if it's what greater than what your expectation you what accept. So that's just the concept behind this. That is your ARR that you get. If it's below what the expectation you ask, if it is below you reject, and if it is, so let's take for example this. If this man requires what a rate that's what 20% per what on this investment, if it requires a rate that's 20% for this investment, should he what go into this investment or not? So we just have to use this what formulas in calculating this. These are what all we have to look for is what the average profit first and the average investment. So how do we get the average profit? Then from this formula, profit is what the cash inflow minus what depreciation. Like I said, what depreciation is like your initial investment, while your cash inflow is what the sum that you are getting. So if you look at year 1, year 2, year 3, year 4, these are the sums that you got. So if you should sum all this together, that's going to be what your cash inflow, that is the sum that you have here. Why for your depreciation, it's the initial investment. So if you sum all this minus this, it's going to give you a profit. So by the time you sum all this minus this, your profit is going to be what 25,000 naira. And how do you get what your average profit? I said your average profit is what profit over what the number of years. So the number of years, we have 4 years here. So 25,000 naira divided by 4, that's going to be what? 6,250. So we've got our average profit. The next thing is to get what? The average investment. What's the average investment? So average investment is what? Your initial investment plus what? Your scrap value divided by 2. But in this scenario now, we're not giving what? The scrap value. So what's going to be our scrap value? It's going to be 0. So our average investment is going to be what? 80,000 plus 0 divided by 2. So our average investment is going to be what? 40,000 naira. And how do we calculate what? The ARR. The ARR in this is going to be given as what? 6,250. At least the average profit divided by the average investment, which is 40,000 naira, times what? 100%. So this is going to give us what? 15.62%. So the average rate of on this illustration is what? This. But the investor is expecting what? 20%. So what are you going to advise the investor to do? The advice is what? Reject what? This proposal. That's that on what? Your ARR. So take note of the formulas, depreciation, and when your scrap value is added. And in case, probably let's say after the third year, he invested another 20,000. How are you going to know that if he added a capital to, you are going to see your year 3 repeated twice, and you can say something like this, 10,000 naira. So it's going to be in what? Bracket. So the bracket here is indicating that what? It's an additional what? Capital to the investment.